Okay, let's get into it. Today we are diving into what might be, I think, the most important macroeconomics case study of the last decade.
Oh, easily.
We're talking about the huge decision by the Bank of Japan, the BOJ, to finally normalize its monetary policy.
That's right. If you're studying global finance, this is absolutely essential.
Yeah, if you want to understand the limits of what a central bank can do, this deep dive is for you.
Absolutely. For, what, 30 years, Japan has basically been a global laboratory for fighting deflation. I mean, they've used some pretty radical tools.
Negative interest rates, zero rates, massive quantitative easing.
All of it. So our mission today is to really understand why the BOJ chose this moment to reverse course, what normalization even means for a country with so much debt.
It's a real masterclass in economic subtlety, isn't it?
It really is.
So let's start with the headline number, the one that really signaled the end of an era.
The big one.
The BOJ announced it's raising its short-term interest rates to 0.75%.
Right, and I know, 0.75%. It sounds like nothing compared to the US or Europe.
It sounds tiny.
But in Japan, that's the highest it's been since 1995. You have to understand, we're watching them close a chapter on a whole generation of monetary experimentation.
And that number, that 0.75%, it needs context. It's not just a random hike.
Not at all. It's part of a very careful, very slow exit strategy. Remember, it was just last year they finally got rid of their negative interest rate policy.
Which had been in place since 2016. That was the policy where they were literally charging commercial banks to hold money, right?
Exactly, trying to force that money out into the economy. So this move isn't a sudden jerk on the wheel. It's a slow, deliberate retreat from these extreme policies.
Can you just quickly define those for us? QE and NIRP, what did they actually involve?
Sure. So QE, quantitative easing, meant the BOJ was buying up enormous amounts of government bonds, other assets too, just to flood the market with cash and keep borrowing costs low.
And NIRP?
NIRP, the negative interest rate policy, was that really unprecedented step of penalizing banks for hoarding cash. So by moving up to 0.75%, the BOJ is basically saying, okay, the state of emergency is officially over.
And the reason for this historic pivot, the ultimate goal, it all comes down to a concept that's critical to grasp: the virtuous cycle.
Yes. The BOJ needs to create a self-sustaining engine for growth. And they define that as rising wages plus rising prices.
So they want companies to feel confident enough to raise salary.
Which then gives people the purchasing power to accept a healthy, stable 2% inflation rate. That specific balance is the key. It's how they hope to escape 3 decades of economic stagnation.
What's really fascinating, though, is how carefully they're doing it. They raise rates, yes, but they immediately say that the real interest rate is still negative.
And just a quick note, if you're finding this content helpful, please do stick with us to the end. It really helps out the channel and, encourages us to keep this work going.
Can you break that down, the real interest rate?
Of course. It's the nominal rate, so that 0.75% minus inflation. And because inflation is still running above that, the real rate remains, as they put it, significantly negative.
So even with a hike, money is still cheap.
Exactly. That's the counterintuitive part. By keeping the real rate negative, they're making sure financial conditions are still fundamentally accommodative. They're not trying to choke off the economy.
It's like they're gently tightening the screws.
But making sure the horse doesn't stop running. It's a signal that they prioritize stability and growth over just stamping out inflation quickly.
Okay, so let's look at the data that forced their hand. Why now?
Well, the main driver is just persistent inflation. It has been running above the BOJ's 2% target for 44 consecutive months. That's almost 4 years.
44 months, wow.
Yeah. When they made the call, consumer price growth was at 2.9% in November. At a certain point, you just can't claim that inflation is transitory anymore. You have to act.
But this is where it becomes a real tightrope walk. That virtuous cycle you mentioned, it depends on wages keeping up with prices.
It does.
And yet, the data from the labor ministry shows that real wages, the actual purchasing power of the average worker, have been falling for 10 months straight.
A huge tension. Inflation is outrunning wage growth, and that's a massive risk. It could break the cycle before it even gets going. It creates a very real cost of living crisis.
So how does the BOJ justify the hike then if real wages are falling?
It's a big forward-looking bet. They're betting on future corporate profitability. Their own projections say that core inflation, which excludes volatile food prices, will probably slow down, but only sometime between April and September of 2026.
Mid-2026. That seems like a really long time to wait for things to cool off. What gives them that confidence?
They point to a couple of things. First, they expect the global growth in food prices to slow down. And second, they're counting on the delayed effects of government stimulus measures. But crucially, their own statement said they have high confidence that the mechanism of moderate wage increases plus price increases will hold.
So they're basically trying to validate future wage negotiations by making this small move now.
That's a good way to put it. They're saying the economy has enough underlying momentum to sustain wage growth, which justifies moving away from zero today.
All right, so if that's the theory, then the next big question is, how did the markets react?
The market reaction is always key, especially when it comes to government debt. As you'd expect, we saw a sell-off in Japanese government bonds, the JGBs.
So yields went up?
They shot up. The yield on the 10-year JGB went past 2% for the first time since 1999. The 20-year yield also spiked dramatically. And when yields go up, it signals rising borrowing costs for the government.
Which connects monetary policy directly to public finances. This is where the pressure really starts to build.
This is where it gets very, very tense. Japan has the highest debt-to-GDP ratio in the world. It's sitting at nearly 230%, according to the IMF.
230%.
Just think about the math there. Even a tiny increase in the interest rate adds billions of dollars to the government's annual interest payments. Managing that fiscal drain is probably the single greatest economic challenge Japan faces.
So what about the currency? Usually, higher rates mean a stronger currency. Did that happen with the yen?
Ironically, no. The yen actually weakened a little bit right after the announcement. It fell about 0.25% against the dollar.
That seems like a paradox. Why?
It's all about market skepticism. See, the yen is a huge part of the global carry trade, where investors borrow in a low-rate currency, like the yen, to invest in higher-rate ones, like the dollar.
I see.
Since the BOJ has signaled this normalization will be extremely slow, not a rapid tightening like in the U.S., investors are betting that the gap between Japanese rates and global rates will stick around for a long time.
So the market thinks the slow pace makes the yen a good currency to borrow for the foreseeable future.
Precisely. They're happy with the stock market. The Nikkei 225 gained over 1% because they like the predictable, slow approach. But they aren't rushing to buy yen yet.
And this cautious reaction is probably amplified by the state of the real economy.
Yes, that's another critical point of tension. They're hiking rates while the economy is actually struggling.
The latest GDP numbers showed a contraction, right?
A bigger one than expected.
Hmm.
The economy shrank by 0.6% quarter on quarter, which is 2.3% on an annualized basis. So yes, they are hiking rates into a shrinking economy.
It's like hitting the gas and the brake at the same time.
It is. It's a historically difficult thing to do, and it just tells you how serious the BOJ is about managing inflation expectations, even if it causes some short-term pain.
Let's look forward then. The current rate is 0.75%. When we study monetary policy, we always talk about the terminal rate. What does that path look like for Japan?
The terminal rate or the neutral rate, it's like the economic speed limit. It's the theoretical rate that perfectly balances inflation and growth without causing a recession.
The sweet spot.
Exactly. And analysts like those at Oxford Economics, they're projecting the BOJ will probably raise rates again in mid-2026, maybe hitting 1%.
Only 1%. That seems incredibly low compared to the U.S. where rates went over 5%.
It is low, but Japan's potential for growth is also low. The BOJ itself admits it's hard to estimate, putting the neutral rate somewhere between 1% and 2.5%. But the consensus is they'll keep climbing very, very gradually.
Which brings us to the political angle. There's always a political angle. The yen has weakened over 2.5% since the new Prime Minister Sanai Takaichi took office.
A crucial detail. PM Takaichi has historically been a proponent of looser monetary policy. She wants to support growth. So you can see a potential conflict brewing. If inflation cools down toward 2% in 2026, there could be major political friction over any more rate hikes.
But she accepted this current hike. Why do you think she did that, given her past views?
The analysis suggests it's down to two very urgent factors. First, the weak yen. It hurts consumers through import costs, and that's politically very unpopular.
And the second?
The cost of living crisis. It's a huge public issue. But to balance this out, the cabinet also approved a massive fiscal stimulus package.
So more government spending.
A lot more. About 21.3 trillion yen, or $135.5 billion, to boost the slowing economy and help consumers who are getting hit by inflation.
So you have this incredible contradiction. The central bank is slightly tightening monetary policy while the government is deploying massive fiscal stimulus.
It's a textbook example of central bank independence clashing with political reality.
So if we pull all of these threads together, what's the final provocative question for us to think about?
I think the fundamental question, the one every student of macroeconomics should be wrestling with, is this. How can a country with a 230% debt-to-GDP ratio manage the dual challenge of huge fiscal stimulus plus the rising cost of its own debt?
Can they do both at the same time?
Can they navigate that pressure without either defaulting or killing the very growth they're trying so hard to create? That balancing act, that is what will define Japan's economic future.
A truly fascinating and crucial deep dive. So if you got a lot out of this lesson, please subscribe to the channel, hit that notification bell, leave a like, and share it with your colleagues. It helps us so much to keep the channel going. Thanks a million.